you're doing AFR, if you're doing FR, if you're doing BDA, basically this is a common what? Is a common area. So for example, in AFR and also FR, this is like a compulsory question. If you're doing advanced financial reporting, you're doing financial reporting and analysis, this is actually a compulsory what? A compulsory topic. So the exam will be sitting for from 20th of April, you will come across a question from this topic of group account. And maybe as far as the group account is concerned, there are those particular basic things you must be able to remember. For example, you should be able to identify a subsidiary company. You should be able to identify what is an associate. You should be able to identify what is a joint venture. That is a basic thing you must be in a position to do anytime you come across a question for group account. Remember, in this case, we said a subsidiary company. This is basically a company which is controlled basically by the parent company. And the parent company controls by the subsidiary by having acquired between 51% to 100%. So mean that if you're told the investor company, or basically the parent company acquired between 51 all the way to 100% of the shares issued by the other company. So the other company, or basically the investee company, we say is a subsidiary. On the other hand, when we talk about a joint venture, basically we say that this is a company whereby the parent company exercises something called a significant influence. The parent company exercises significant influence over associate by having acquired between 20 all the way to 49% of the equity or the ordinary shares which are issued by who? Which are issued by this particular company here. So if you are told maybe A Limited acquired between 20 to 49% of the shares, maybe which are issued by B, automatically B will be what? Will be an associate. On the other hand, when we talk about a joint venture, which can also be known as a joint arrangement, so this is an entity over which the parent company and another entity exercises something called a joint what? Exercises something called a joint control. And in this case, a company is actually regarded to be a joint venture if the parent company and another entity acquires equal shareholding of 50%. The parent company has acquired 50% shareholding, and the other entity has equally acquired 50% shareholding. So that particular company is actually regarded to be a joint venture. So that is a basic thing you should be able to remember as far as the group account is concerned, because I hope you can be able to recall we said anytime you have come across a question for group account, the first thing you must be in a position to do is to come up with a group structure. If basically you can't be able to remember this, then it also means that coming up with a group structure basically is what? Is a challenge. So this is the first thing you must be able to remember. And then from there are other basic things you must also be able to remember. For example, the computation of goodwill. And actually in this case, what is important first of all here is to remember that we only compute the goodwill arising from the acquisition of a subsidiary. So we don't compute the goodwill arising from the acquisition of associate, and also the goodwill arising from the acquisition of a joint venture. So in this case, we only compute the goodwill arising from the acquisition of who? The goodwill arising from the acquisition of who? Of the subsidiary company. So mean that in this case, we don't compute the goodwill arising from the acquisition of the associate. We don't compute the goodwill arising from the acquisition of who? Of the joint venture. Then when computing this particular goodwill, remember in this case, first of all, the goodwill basically is the difference between the purchase consideration which was paid and the fair value of the net assets which were basically what? Which were acquired. That is how we compute the goodwill, the difference between purchase consideration which was paid and the net assets which were acquired. And then when computing this particular goodwill, basically there are two methods which can be used. Number one, we have the full goodwill method, and basically number two, we have the partial goodwill method. In most of the examination questions, the examiner will not tell you use the full goodwill method or use the partial. The examiner will not tell you that. In most of the cases, if the examiner wants you to use the full goodwill method, you will come across this particular information in the additional information that it is the policy of the group. It is the group policy to value, the policy of the group to value the non-controlling interest at the full or basically the fair value, at the full or fair value. So you'll come across that statement in the additional information that is the policy of the parent, it is the policy of the group to value the NCI at full or fair value, in which case the examiner in most of the cases will proceed and basically give you something called the NCI at fair value. So if you happen to come across that information, that it is the policy of the group to measure NCI at fair or full value, and the examiner equally has given you this one, the NCI at fair value, then automatically we say it is upon you to know that when computing the goodwill, you have to use the full goodwill method. Now, when using this other method, and actually even before we discuss on the partial, recall, we say that under the full goodwill method here, we compute the goodwill of the parent and the goodwill of the non-controlling interest, because we said in a subsidiary company, assuming the parent company, for example, has acquired 80% of the shares which are issued by the subsidiary, ordinarily we said in a subsidiary, we have two categories of shareholders. So two group of shareholders. We have the parent company, which is the majority shareholder here, and then we have the remaining 20% of the shares, which are held by the minority shareholders. Remember, in this case, we said the interest of the minority shareholders, we refer to it as the non-controlling interest. In other terms, NCI, these are like the minority shareholders. So therefore, under this method here, we compute the goodwill of the parent and basically the goodwill of who? Of the NCI. And I hope you can be able to recall, we say to compute the goodwill under the full goodwill method. First of all, we start by taking the purchase consideration, which is paid by the parent. When the parent company acquired 80% shareholding, how much amount did the parent company pay? And then out to this, we add something called the NCI at fair value. In this case, we said the NCI at fair value. This refers to the purchase consideration, which was paid who? Or which was paid by the minority shareholders. When the minority shareholders acquired 20% of their shares, how much amount did they pay? And then for this, we lay something called the fair value of net assets, which were acquired. And actually, we said in most of the cases, what the examiner will not give you is, as far as the computation of goodwill is concerned, is this. This is something which the examiner will not give you. The fair value of net assets acquired. And actually, we said you need to compute that. How do we compute that? So when computing the fair value of the net asset acquired, we are interested with determining or basically or knowing the fair value, or what was the fair value of the subsidiary company net asset on the date of acquisition. When the parent company and the NCI acquired their shareholding here, what was the fair value of the subsidiary company net asset? And in this case, we said to compute that, we take the subsidiary company ordinary share capital plus the pre-acquisition reserves. The pre-acquisition reserves, we said, these include the share premium, the retained earnings, and any revaluation reserve which the subsidiary company was having at the date it was acquired. So therefore, that's basically how we compute the goodwill using the full goodwill method. So then under the other method, that is the partial goodwill method, we said we only compute the goodwill of the parent company only. And actually, we said also the examiner will not tell you use the full, the partial goodwill method. You'll come across some information whereby you're told in the additional information that it is a policy of the group to value or to measure NCI at their proportionate share of the net asset. So it is a policy of the group to measure or to value NCI at their proportionate share of the fair value of their net worth asset. If you happen to come across that information, is then upon you to know that when computing the goodwill, you compute the goodwill using what? The partial goodwill method. This is the other concept you need to remember, because anytime you come across a question for group accounts, especially those who are doing FR, AFR, you may see that in none of the question you are required to compute the goodwill arising on acquisition, maybe allocated 4 months or basically 6 months. So that is the other thing you must be able to remember. Then from there, you should be able to remember how do we prepare the group accounts. And in this case, for example, we said if the parent company has acquired a subsidiary, then when preparing the group accounts, we combine similar items. In other terms, when preparing the group accounts, we use something called the full consolidation method. The full consolidation method basically requires that when preparing the group accounts, then we should basically combine. In other terms, we should add together similar items of revenue, expenses, assets, and liabilities, those of the parent and those of the subsidiary. But we said when preparing the consolidated income statement, you must be able to determine whether the subsidiary was acquired during the current year. If the subsidiary was acquired during the current year, for example, maybe 6 months to the end of the year, 9 months to the end of the year, then we said you should only take into account the revenue and expenses of that subsidiary from the date it was acquired. You apportion its revenue and expenses on time basis, and then you combine that with the revenue and expenses of the parent. Though we say that one does not apply when it comes to the preparation of the consolidated statement of financial position. Then, if the parent company has invested or has acquired an associate or basically a joint venture, then we said that we prepare the group account here using something called the equity method. Now, equity method basically is a method of accounting which requires that similar items of asset, liabilities, revenue, and expenses, those of the parents, those of the subsidiary, should not be combined. They should not be combined. Instead, we said when preparing the consolidated income statement. As far as the associate or joint venture is concerned, we include something called the parent company share or the group share of the associate or joint venture profit after tax. And in that case, it's also very important for you to recall the associate and joint venture are accounted for in the same way. So we account for the investment in associate and joint venture using the equity method. So when preparing consolidated income statement, don't combine similar items of asset and similar items of revenue and expenses, those of the parent, those of the associate or those of the joint venture. Instead, compute what is the parent company share of the associate or joint venture profit after tax. And basically recognize that as part of the other incomes, you can add it to the gross profit, or maybe you can add it to the operating profit. Then when preparing the consolidated statement of financial position, equally we said we don't combine similar items of assets and liabilities, those of the parent and those of the associate or those of the joint venture. Instead, we compute something called the investment in associate, investment in joint venture, and that is basically what we recognize in the consolidated statement of financial position as part of the non-current asset. So that is the other thing you must be able to recall for you to be able to handle this particular question for a group account. How do we prepare the group account whereby the parent company has invested in a subsidiary, has invested in associate, or basically the joint venture? Then from there we said, actually, what is important here, because after maybe for example, if you are given a question and the parent company has invested in a subsidiary, we said to combine similar items of asset, liabilities, revenue, and expenses. That is never a challenge. So the challenge is basically the consolidation adjustment, because we said anytime you come across a question for group account, the number of consolidation adjustments you must be in a position to do. And we said, as far as the preparation of consolidated statement of financial position is concerned, there are 3 key consolidation adjustments you must be in a position to deal with. One of it, and you'll come across that in all questions, is the fair value adjustment. Usually, you'll be told on the date of acquisition, the subsidiary company here revalued assets, but never accounted for that. So that one is called the fair value adjustment or the fair value exercise. And we said in relation to that, we make 2 adjustments. You determine the revaluation gain, you compute depreciation under chart. You must be able to record how do we account for those 2 items. Number 2, you should also be able to compute, or actually you should also be able to deal with the other consolidation adjustment in relation to the unrealized profit. And it is what? A profit. Remember, you say that anytime you have the sales between the parent and the subsidiary, that may give rise to something called unrealized profit if the goods which were sold to the purchasing company will remain unsold, or some of them will not have been sold at the end of the year. You have to record the formula for computing the unrealized profit, and basically how do we account for that? The other consolidation adjustment you must be in a position to deal with is the amount of intercompany debt, which is equal and which is not equal. So I think those are basically some of the things you must be in a position to deal with anytime you come across a question for for a group account. And basically, remember, we have said that this is basically a compulsory area, and therefore, if, for example, you're doing, for example, AFR, we have said that these are compulsory questions. So therefore, you should be well prepared to handle a question coming from this particular this topic. So I want us to do maybe, if possible, I don't know whether we can do 2 questions on this. Now, if you go to the chat box, there are some questions I've shared there. There are a number of questions I'm borrowing from a paper which is done in 𝗬𝗂, which is called Financial Statement Analysis. There are also so many questions which are related to the questions from your papers. But because we have attempted most of the questions from your papers, I felt that there was a need maybe to borrow some questions, maybe from that paper for FSA. So I don't know whether you're in a position to do what? To download that handout, or those particular past papers in the chat box. I don't know whether you can see that in the chat box. Bernard, can you see those particular past papers for 𝗬𝗂? For 𝗬𝗂? Yes. So I don't know whether you're in a position to download them. If you're in a position to download them, then I want us to go to this question here. There is a very good question for April 2024. April 2024. April 2024. Question number 2. Question number 2. So if you're in a position to download those past papers, maybe you can screenshot that question, and maybe you share that question in the chat box here. if in a position to download those papers, do a screenshot, and maybe share that in the chat box. So if you're having a challenge in terms of getting that question, let me know in the chat box. Are you in a position to download those papers, Vanessa? If you're in a position to download those papers, let me know. Teresia, are you able to download those past papers? Ismail is having a challenge. Yes. Okay, Sawa. So if you're in a position to download them, maybe you can assist. So the document is here. The document is, let me share the document afresh. Yes, so I think the document has been reshared again, sir. I've reshared the document again in the chat box. User, I hope now you're in a position to see that document. Are you in a position to see that document? Yes, so I'm saying, yes, Sawa. So just download those papers. You download those particular past papers, and then you go to this question here. The sitting of April 2024. We have a very good question there on group accounts. Question number 2. Question number 2. Once you get the question, let me know. Once you get that question, let me know. I don't know whether I can be able to share a screenshot of the same in the chat box. Let me do that. But equally, if you're in a position to share a screenshot of that question in the chat box, I'll be able to appreciate. If you're in a position to share a screenshot of that question in the chat box. Let me see whether I can be able to do that very fast, to share that in the chat box. Bernard, thank you. Yes, thank you, Bernard. Yes, I think the question has already been shared there. I think the question has already been shared in the chat box. So everyone to confirm whether you have that question. Stella, do you have the question? Do you have the question? Walter, Hilary, do you have the question? If you have the question, please confirm so that we move together. Dagote, uko na hiyo swali? Okay, sawa. Naona takwa group iko shared hapo. Okay, sawa. So I think everyone is having the question now. Yes, so thank you. So let's now move together. So what are we told in this particular question here? What are we told in this question? Is a very good question on group accounts. A very, very good question on group accounts. Group accounts. Yes, so what are we told here? The question reads, on 1st of October 2023, 𝗕𝗏 Limited acquired 75% of 𝗬𝗏𝗇 Limited ordinary shares for an immediate cash payment of 11.2 shillings per acquired share. In addition, 𝗕𝗏 Limited was to pay a further 5,600 million on 1st of October 2024. So in this case, you can see this particular amount of 56 million will be paid on 1st of October 2024. But if you check on the first sentence of that paragraph, the date of acquisition is 1st of October 2023. So therefore, this is a consideration to be paid in future. In other terms, we refer to this as a deferred consideration. And I hope you can remember we said any deferred consideration has to be discounted to its present value using the parent company COC, that is cost of capital. So we are told 𝗕𝗏 Limited cost of capital is 12%, and then you're told 𝗕𝗏 Limited has recorded the acquisition consideration as an investment in its financial statement. So, and then you're told on 1st of October 2023, 𝗕𝗏 Limited also acquired 50% shareholding in 𝗕𝗏 Limited, having entered into a joint arrangement with a core investor for a joint control over 𝗕𝗏 Limited. Automatically, this 𝗕𝗏 Limited is a joint venture because you can see the parent company, another investor, and another co-investor basically acquired joint control. And then from there, we're given the draft statement of profit or loss and other comprehensive income, basically for the three companies, 𝗕𝗏, 𝗬𝗏, and 𝗕𝗏. And then down there, we have the equity balances of 𝗬𝗏 as at 1st of April 2023. 2023. Then we are given some additional information, number 1, number 2, number 3, 4, and 5. So what are we required to do here? We're required to compute the goodwill arising on acquisition of 𝗬𝗏. And then part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of October 2024. Remember what we said. If you happen to come across such a question for group account, the first thing you should always do is to come up with a group structure. The group structure is what will guide you in terms of preparing the group account. So therefore, that is the first thing we need to do here. Basically, to come up with a group structure, we need to come up with a group what? We need to come up with a group structure. Group structure. And actually, we are going to use the information in paragraph 1 to come up with this group structure. So let's go back to paragraph 1 of our question, paragraph 1. And we are told on 1st of October 2023, the company which is called 𝗕𝗏 Limited acquired 75% shareholding of 𝗬𝗏 ordinary shares for an immediate cash payment of 11.2 per share acquired. So first of all, we are told the company which is called 𝗕𝗏 Limited. 𝗕𝗏 Limited, we are told that this one acquired 75% of the ordinary shares which are issued by the company which is called what? Which is called 𝗬𝗏. Which is called 𝗬𝗏 Limited. And actually, we are told the acquisition took place on 1st of October 2023. Automatically from this information, this one will be the parent company, whereas this one will be the subsidiary. So that will be the subsidiary. So that is the information which we have there. And then can we go back? Can we go to paragraph 2 of that question? In paragraph 2, we are told on 1st of October 2023, on the same date here, 1st of October 2023, 𝗕𝗏 Limited acquired 50% shareholding in 𝗕𝗏 Limited, having entered into a joint arrangement with a co-investor for joint control over 𝗕𝗏. So we are told on the same date, 𝗕𝗏 Limited here acquired 50% shareholding in a company which is basically called what? 𝗕𝗏 Limited, and that took place on 1st of October 2023. Now, in this case, who can tell us this company here, which is called 𝗕𝗏, is this an associate? Is it a joint venture? Is it a subsidiary? Who can tell us? This company here, 𝗕𝗏, is it a subsidiary, joint venture, or an associate? Or an associate? Yes, automatically this one is a joint venture. This one is a joint what? This one is a joint venture. So therefore, that is our group structure here. We have 3 companies. We have parent, we have subsidiary, and then we have what? A joint venture. Now, even before you proceed basically to prepare what is required, we say it is always important basically for you to identify whether these companies were acquired during the current year. Were they acquired during the current year? And actually, we do that first of all by identifying the date of consolidation, which is known as DOC. The date of consolidation, this is part of the requirement. Can we go to the requirement? Specifically part B of the question. When are we required to prepare the group account as part B of the question? I hope you can see the date of consolidation. Who can see the date of consolidation, the date we are required to prepare the group account in part B of the question? It is 31st of March. 31st of March 2024. That is basically the date of consolidation. So if that is the date of consolidation, who can tell us when did this particular financial year started? When did this particular financial year started? Because we said we should be in a position to identify that date. When did the financial year started here, Esther, Charles, Betty? Yes, so we said for you to be able to know when the financial year started, you need to ask yourself, when will the next financial year start? If this year ended 31st of March, the next year will start 1st of April. Sasa, 1st of April, Walter. The next year will start 1st of April here. So if it will start 1st of April, so it basically means that this year started on 1st of April 2023. That is basically when the year started. So having those 2 dates, then we should be able to determine whether these companies were acquired during the current year or not. So by checking the date of acquisition, because this is now the date of acquisition, which is abbreviated as DOA. So you can see both of them were acquired 1st November, 1st of October. Sorry, this was November or October. This was November or October? Yes, this one was October. This one was October. So basically, both of them were acquired 1st of October 2023. And actually, 1st of October 2023, you can see it is within this year. So 1st of October 2023. That is basically the date of acquisition. So therefore, what we need to do here is basically to determine how many months do we have between these two dates, the date of acquisition and the date of consolidation. How many months do we have between these two dates? How many months do we have between these two dates? So we have October. Yes, I'm told we have 6. We have October, November, December, January, February, and March. So we have 1, 2, 3, 4, 5, 6. So in our case, we have what? 6 months. So having that information is very important because when preparing the consolidated statement of profit or loss, we are going to take into account the revenue and expenses of Shower for 6 months. Equally, this is a joint venture. We have said we don't consolidate a joint venture. We don't include the revenue and the expenses of the joint venture in the consolidated income statement. Instead, we will take into account the parent company share of the joint venture profit after net tax. So when doing that, we will compute the profit of this joint venture basically for 6 months, and then we get the group share of that. So therefore, that is basically our group structure. So having that, then we can be able to proceed and basically compute what is required. Remember, we said that if you're doing this particular question in an examination setup, don't start with the workings, because we said those workings will just consume a lot of your time. Those workings, they are not what marked. Just go straight to computing what is required, or basically preparing what is required. Any working which you have to do, you do it per need basis. Maybe there is something you need to compute, like the unreleased profit, or maybe the depreciation other charge. So that maybe you can adjust something like the cost of sales. So compute it per need basis, but don't start with those particular workings, because by the end of the day, those workings, they are not marked. So we start with part A of the question, and we are required to compute the goodwill on acquisition of Shower. That is what we are required to compute in A. Goodwill on acquisition of who? Of Shower Limited. Shower Limited. So even before you compute this, it is always important for you to check in the additional information on information which you are given there, so that you know which method to use when computing the goodwill. So like in the additional information, you must be given information on how the group measures the NCI. So like in our question, that one is in note number 2. Note number 2, what are we told? We are told the group policy is to measure the non-controlling interest at their fair value on the date of acquisition. So if you come across that information we have said, it is obvious that when computing the goodwill on acquisition of the subsidiary, you have to use what? The full goodwill method. You have to use the full goodwill method. And basically, that is as per the information which are given in note number 2. So if that is the case, then we can proceed and compute this goodwill. And basically, we need to have 2 columns here. And I hope you can see our values are given in million of shillings. So when computing the goodwill, we always start with the purchase consideration. The purchase consideration, which was paid by the parent company. That's what we start with. Purchase consideration, which was paid by who? The parent company. Now, we have information about this within the first paragraph. Within the first paragraph of our question, not note number 1, but the paragraph 1. Let's go back to paragraph 1. You're told on 1st of October 2023, 𝗕𝗏 Limited basically acquired 75% of Shower for an immediate cash payment of 11.2 shillings per share acquired. And then you're told, in addition, 𝗕𝗏 Limited agreed to pay further amount of 5,600 million on 1st of October 2024. Now, in this case, therefore, there are 2 purchase considerations we are going to consider here. Number 1, the first consideration, which was paid by the parent, we refer to that, or basically that is the cash consideration. The cash consideration, I hope you can be able to recall, we discussed 4 types of consideration. We talked about cash consideration, the deferred consideration, the share exchange consideration, and the contingent consideration. We said mostly would come across 3: cash consideration, deferred, and the share exchange. Now, we said this one does not have any special treatment. The cash consideration does not have any special treatment. But in this case, you can see we are not given the exact amount which was paid. We are told the parent company was to pay. The parent company was to pay shillings 11.2 shillings 11.2 for every share acquired. For every share which was acquired. I think in this case, therefore, what we need to do is basically to determine how many shares were acquired by Hale in Shower. Number of shares acquired. Number of shares acquired. And basically, we said for you to be able to determine the shares which were acquired, first of all, you need to determine how many shares are issued by the subsidiary. So if you know the shares issued by this, then you can be able to determine the shares which were acquired, because this company acquired 75% of the shares issued by Shower. Now, usually we say you get this information from the balance sheet of the subsidiary. If you check on this question below paragraph 3, we only have income statement of the 3 companies. Do we have the balance sheet of the 3 companies? No, because we said the number of shares for this, you should get it from the balance sheet and the equity. But above the additional information, we are told the equity balances of Shower is at 1st of April 2023 comprised of the following. So we are given the share capital or the equity balances of this company on 1st of April 2023. Remember, that is the start of the current year. So our interest there is the share capital. What is the share capital of Shower? The share capital of Shower is 5,000. So from that, we can be able to determine the shares issued by this, because we will take 5,000, we divide that with the par value, and basically in that case, the par value is 10, and this will give us what? This will give us 500 million. So these are the shares which are issued by Shower. So therefore, how many shares did Hale Limited acquire in Shower? So the number of shares which were acquired should be equal to the shares issued by Shower, 500 million. We multiply that with what? We should multiply this with what for us to be able to get the number of shares which were acquired? We multiply this with what? You can tell us. We want to know how many shares did Hale Limited acquire in Shower. Yes, automatically we should get 75% of that. 75% of that. That will give us how many shares? That will give us how many shares? Will give us how many shares? How many shares here? 75% of 500. Yes, that one will give us 375. 375 million. So these are the shares which were acquired. And remember, what you're told is that the parent company was to pay an amount of how much? Was to pay 11.2 for every share which was acquired. That is the cash consideration. So therefore, the cash consideration would be 375 times 11.2 times 11.2. That will give us an amount of how much? That is our cash consideration. That is our cash consideration. Our cash consideration in this case, I'm told that one will be 4,200. That one will be 4,200. Then remember also in paragraph 1, we are told there is a deferred consideration. A deferred consideration basically is a consideration to be paid in the future. There is a deferred what? Consideration. And actually, what have we told in paragraph 1 in relation to that deferred consideration? So we are told the deferred consideration. We are still in paragraph 1, sentence 2. We are told in addition, Hale Limited, paragraph 1, sentence 2. In addition, Hale Limited was to pay a further 5,600 million on 1st of October 2024. That 5,600 million will be paid on 1st of October 2024. 1st of October 2024. You can see this one is exactly 1 year from the date of acquisition, because the acquisition took place on 1st of October 2023. That amount will be paid exactly after 1 year. That is on 1st of October 2024. Now, what we said is that consideration, because it will be paid in the future, we discount it to its present value. How do we discount that? We take 5,600 million, we multiply that with the present value interest factor at the rate of 10%. Remember, in this case, we use the parent company cost of capital, which is given in paragraph 1, not 10%, rather 12%, 12%, and basically for 1 year. For 1 year. So remember, the formula which we use here is 1 plus R raised to power negative N. So that is the formula which we use to discount this. So we multiply this with the 1.12 raised to power negative 1. Raised to power negative 1. So that one is the deferred, the present value of the deferred what? Consideration. So give me the present value here. So first of all, you work out the present value interest factor. Yes, and this one will give us what? This one will give us 5,000. That one will give us 5,000. So that is the two forms of consideration which was paid by the parent. And then to this, because you're using the full goodwill method, we proceed and we add the NCI at fair value. The NCI at fair value, and then C at fair value. This one is given in note 2. If you go to note 2 of our question, we have the NCH fair value. Note 2 sentence 2. Note 2 sentence 2, we are told, as at 1st of October 2023, the fair value of the non-controlling interest in 𝗬𝗏 amounted to 3,000 million. So we have this one, 3,000 million. Sasa, yes. So let's first of all, we get the total here. The total will be 12. Will be 12 what? 200. I hope that is what you're getting as a total. 12,200. 12,200. 12,200. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes, 12,200. And then out to this, we basically proceed and we lay something called the fair value of the net asset which were acquired. This is something which the examiner will not give you, the fair value of the net asset which were acquired. So in this case, we said we need to compute the fair value of the subsidiary company net asset on the date of acquisition. And actually, we said we compute that by taking the subsidiary company ordinary share capital plus the pre-acquisition reserves. So in this case, the first thing we need to consider here is the subsidiary company ordinary share capital. And we have this above the additional information number 1. Above additional information number 1. So the share capital of the subsidiary is 5,000. And then below that, we also have share premium. Remember, in this case, we said, in case you're given a share premium in the balance sheet of the subsidiary, unless told otherwise, that one is always treated to be pre-acquisition, unless told otherwise. So therefore, this one is a pre-acquisition. And then from there, we have the retained earnings. Now, that particular retained earnings which you're given there is not the retained earnings at the date of acquisition. Actually, we said anytime you come across a question for group account, whether it is in BDA, FR, AFR, and the subsidiary company was acquired during the current year, like in our case here, the examiner will not give you this. So therefore, we say we should be in a position to compute the retained earnings on the date of acquisition, because the retained earnings which are given in note above the additional information number 1 is the retained earnings there. The retained earnings at the start of the year. Is that what you're interested with? No. We're interested with the retained earnings here. And actually, we say to compute that is very simple. What we do, we take the retained earnings at the start, whatever we have there, the retained earnings at the start of the year, which is given as 52, So that is the retained earnings there. And then we take the profit which was reported by the subsidiary for the whole year, and then we compute how much profit was reported before the subsidiary company was acquired, the profit from this date to this, and then we add it to the retained earnings at the start. So the first thing we must have here is the profit of the subsidiary for the whole year. So that one automatically you get it from the income statement of 𝗬𝗏. Can you give me the profit for the year for 𝗬𝗏? From the statement of profit or loss, we have below paragraph 3, profit for the year, and we said profit for the year is the same with the profit after tax. I hope you can be able to see that. Below paragraph 3, where we have the income statement, we go to the income statement of 𝗬𝗏, and we take its profit for the year. Its profit for the year, this one is 1,000. This one is what? Is 1,000. So basically, that is the profit for the whole year. For the whole year. So what we are interested with is the profit from this date to this date. Remember, from this date to that date, we have 6 months. So, and take into account this profit for the whole year. So what will be the profit for 6 months? So we take this one, 1,000 times 6 all over 12. And basically that one should give us around 500. 500, because this one is half. That one should give us what? Should give us 500. So that is how we compute the retained earnings on the date of acquisition. So this one would be 50 what? That one would be 57. That one would be 57. That one would be 57. So we have that. Then there is something also we said you should always check. And this one we said always. You'll come across this in note number 1. If you check on all questions, for example, you have done in FR and also BDA, AFR. So usually in addition information number 1, you'll be told the subsidiary company here on the date of acquisition revalued the assets, but basically never accounted for that. So from that revaluation, you need to check, was there a revaluation gain? Like in our case, let's go to note number 1. In note number 1, you're told the fair value of the net asset of 𝗬𝗏 at the date of acquisition approximated the carrying values, with an exception of an item of plant whose fair value exceeded the carrying amount by 200 million. So the fair value of this item exceeded the carrying amount with an amount of how much? 200 million. Automatically, this one is what? Is the revaluation gain. And because this revaluation gain occurred on the date of acquisition, we said this one is a pre-acquisition is a pre-acquisition revaluation gain. So therefore, any revaluation gain which occurred on the date of acquisition, we also consider it here. So, and that is an amount of how much? That is an amount of 200. I think this basically what we have. This is what we have. We don't have any other component of net assets, and we get the total. Let's get the total. So that one should be 6,011.7. Yes, someone is asking where have we gotten this one? The retained earnings on the date of acquisition. I've said whatever you consider here as far as the retained earnings is concerned, we consider the retained earnings on the date of acquisition here. Now, if you check on the information we have above the additional information, we are given the retained earnings of the subsidiary at the start. Here, the retained earnings which is given above the additional information of 52, this one, 52 is above additional information number 1. I hope you can see that, my good Fred model. Can you see that? Is above additional information number 1. That is the retained earnings at the start. But I've said what we consider here is the retained earnings of the date of acquisition. That's why to make retained earnings happen, and we have added the profit reported by our subsidiary from that date to that date. Sasa? Yes. So this one will give us a total of what? A total of what? A total of 11,700, 11,900. Yes, 11,900. And because you're using the full goodwill method, then we take 100% of this. We're using the full goodwill method. We take 100% of this, which will be 11,900. So we less it from our value up there. And basically the difference which we get here, the difference is what? The goodwill on acquisition. So the goodwill on acquisition is how much? Is 300. So that is basically the goodwill on what? The goodwill on acquisition. Now then, in this case, we need to check whether, are we given any information about the impairment? Was this goodwill impaired? So that one has to be part of the additional information. Yes, and I think we are given some information with respect to that in note number 4. Note number 4, we are told impairment test, which was performed on 31st of March 2024, which is basically the end of the year, reveals that no impairment was suffered. So this goodwill was not impaired. So, but we said in case there was any impairment, or the goodwill had suffered any impairment, so then that one we erase it from this. So you can be told the goodwill had suffered an impairment loss equivalent to 10%. So you should take 10% of this and you erase it from there. You erase it from the value of the goodwill. So meaning that when preparing our consolidated, although we are not required to prepare that, so then you recognize this as a non-current asset in the consolidated statement of financial position. So that is what was required there. And actually you can see significant marks were allocated there. And we said what is marked in such a question are these items. 1, 2, 3, 4, 5, 6. So basically be able to see this how the question is marked. Any 6 at 1, any 6 at 1. And basically once you get 6 items correct, you get all the 6 or the 6 marks. You can see some of the entries here are free. For example, this one was given, although this one was not provided, this one was not provided, this was there. We also have that. We also have the share premium, and I think this one is given. So mean that how many free marks do we have here? 1, 2, 3, 4. So basically it means that you needed to compute some of the items. But if you have noted, most of the questions we have done, usually the subsidiary is acquired at the in course of the year. And basically, if you check on how we have computed these retained earnings, the computation for this is the same in all questions. Questions. So I think in our case we are basically done with that. Let's move to the other part of the question, whereby we are required to prepare the consolidated statement of profit or loss. Now, this one is quite simple, because if you check on the additional information, for example, I don't think we have so many adjustments, because we have note number 1, which is about the revaluation of assets, meaning that in that case, we're going to compute depreciation at the charge automatically. Note number 2 is about goodwill, which does not affect a consolidated statement of profit or loss. Note number 3 is about the sale of goods, intra-group trading. So you need to recall how we adjust for that. Intra-group trading, and also automatically the component of unreleased profit. And note number 4 is about impairment, in which case we say that if, for example, this goodwill was impaired, then any impairment loss for the current year, that one is added to the administrative expenses. No impairment, yes. And then number 5, we are told to assume all incomes and expenses, gain and losses accrued evenly. So therefore, this particular question is quite simple, because you can see, I think we only have 2 consolidation adjustments: intra-group trading, fair value adjustment, and unreleased a profit. So I think we can move and we prepare that. I want to do away with this one because of this. I hope you already have this one with you. I hope you already have this one with you. Yes, so let me do away with this because of my space here. Yes, so what are we required to do in part B? We are required to prepare the consolidated statement of profit or loss and other comprehensive incomes, that is OCI, which is basically for the year, which ended 31st of March 2024. And because we already have the group structure, then preparation of this is quite simple. Quite simple, because we say the group structure is the one to guide you. You should be guided by the group structure, how to prepare what? How to prepare this one. Remember, from our group structure, how many companies do we have? We have 3. We have parent, we have subsidiary, and basically this subsidiary, recall, it was acquired 6 months to the end of the year. So meaning that when preparing this, we will only take the revenue and expenses of our subsidiary for how many months? Only for 6. Then we have a joint venture. Do we consolidate a joint venture? No. In that case, we will not include the revenue and expenses of the joint venture there. Instead, we will compute something called the group share of the joint venture profit after tax. We add that maybe to the gross profit or to the operating profit. So having that, we can be able to proceed, and maybe we prepare this. We will start with the revenue. So in this case, we have said we take the revenue of the parent. Parent is 𝗕𝗄𝗄 for the whole year. And then we take that of 𝗬𝗵𝗶. For 𝗬𝗵, because it was acquired 6 months to the end of the year, we only take the revenue. So we only take the revenue for 6 months. We apportion that on time basis. In other terms, we take half of that revenue, because we have to apportion revenue and expenses of 𝗬𝗵 on time basis, 6/12. So which is the same with half. What is half of 44? Of 88? It should be 44, that is. It should be 44. And then in this case, we should eliminate any sales between the parent and the subsidiary. And I think in our case, we know in note number 3, there was sales between the parent and the subsidiary. Can we go to note number 3? Because I want us, we finalize with that item. In note number 3, we are told during the post-acquisition period. When we talk about the post-acquisition period, we are referring to this period here. The period between the date of acquisition and the date of consolidation. In other terms, the post-acquisition period is the period after the subsidiary was acquired by the parent, this period here. So we are told in the post-acquisition period, as per note number 3, 𝗬𝗏 Limited, which is our subsidiary, sold inventory. Inventory is the same with goods, worth 400 million to 𝗕𝗄𝗄 Limited, reporting a gross profit margin of 20% on these sales. Now, first of all, in our case, what we're interested with is the goods or the inventory which was sold by 𝗕𝗄𝗄 to 𝗬𝗏. So this one, remember, we refer to it as the intra-group trading or intra-group what? Sales. Any sales between the parent and the subsidiary, we eliminate that from the group sales or the group revenue, and also we eliminated from the group cost of sales. So therefore, that amount will be deducted from our sales figure here, the full amount of what? Of 400. And in this case, we say that this is the only consolidation adjustment which affect what? Revenue. And therefore, we say, if you happen to come across any question for group account, make sure you get that item correct. Sasa? Yes, because the only consolidation adjustment affecting revenue is sales between the parent and who? The subsidiary. So this will give us a total amount of how much? No any other consolidation adjustment. This one will be how much? Will be 16 what? 16,600. Then from there, we proceed and we do the same to the cost of sales. The cost of sales, we take that of the parent, basically for the whole year, 65. And then that of 𝗬𝗏, we take half, which is 23. And maybe someone is asking here, why are we not considering the revenue of this company here, which is Ford? Remember, we have said in preparation of the consolidated statement of profit or loss, we don't include the revenue and expenses of joint venture or that of the associate. In other terms, we don't consolidate joint venture and associate. What we recognize here, as far as the joint venture or even associate is concerned, is the parent company share of the profit after tax in the associate, or basically what? A joint venture. Sasa? Yes, that's why you can see we have not included the revenue of Ford there. So, and actually that also applies to all other items of expenses. So we only consolidate the parent and the subsidiary. So 𝗬𝗏, we take half of 46, which is 23. And then in this case, number 1, we less this amount of intra-group trading. The amount of intra-group trading, 400, we less it from the group revenue and the group cost of sales. Then to this, there are other consolidation adjustments which we make here. And the common one is unreleased profit, depreciation, other charge, of which we say both of them should be added here. First of all, can we deal with note number 3? Note number 3. Note number 3, because there was intra-group trading, automatically we must be given information about the unreleased profit. Now, in note number 3, the last sentence we are told, 1/4 of these goods are still in the inventory of 𝗘𝗄𝗃 at the end of the year. So out of these goods, which were sold by Shower to 𝗘𝗃, some of the goods were not yet sold to third parties. Some of the goods was not yet sold to third parties at the end of the year. Now, if you're given that information automatically, what that means is that you have to compute something called the unrealized profit. So let's compute that unrealized profit. We compute that unrealized profit. And for you to compute that unrealized profit, the first thing you need to remember is what? Is the formula. How do we compute the URP? We said we take the unsold goods. The unsold goods, basically multiply that with the gross profit, what? The gross profit margin. So in our case, we are told the goods which were not yet sold by this company were a quarter. A quarter of what? A quarter of the goods which were sold by Shower to 𝗘𝗃. And we know the goods which were sold by Shower to 𝗘𝗃, they had a value of 400 million. So these are the unsold goods. Unsold goods, then you multiply that with the gross profit margin. So in note number 3 still, the first sentence, we're given the gross profit margin. Can you be able to see the gross profit margin? When Shower sold the goods to 𝗘𝗃, it reported a gross profit margin of what? The gross profit margin of what? Over 20%. 20%. Remember, in this case, we say there are some instances whereby the examiner will not give you this one. The margin, he will give you markup. So if you're given a markup, recall, we said you have to convert it to a margin. We said, if, for example, you're told the gross profit markup, maybe in that case is something like 20%. 20%, you're given markup, not margin. We don't use markup here. We don't use markup, use margin. So this, first of all, converted to a fraction, which is 20/100, and that will be 1/5. Basically, what that means is that the gross profit margin, therefore, this one would be 1/5. And then we say to the denominator here, we add the numerator. We add what? The numerator. So this one should be 1/6. In case, for example, this one will be 2/5, then this one would be 2/5. And then to the denominator, we add the numerator. So this one should be 2/7. Sasa? Yes. But in our case, you're given margin here. So this one will be what? This one will be 20 million. This one will be 20 million, because this one should be 100. Yes, 20 million. So remember this one, and it is profit. First of all, we say this one, we add it to the group cost of sales. Number 2, if, for example, you're preparing consolidated statement of financial position, you less it from the group inventory. So, but in our case, we are not preparing consolidated statement of financial position, so we add it here. We add it there. We add it there. Then in note number 1, because I think in this case, we only have 2 key consolidation adjustment, fair value adjustment, and URP. Let's go back to note 1. In note number 1, we know that this company, on the date it was acquired, it revalued the assets. So in which case we refer to that as a fair value adjustment. We said we make adjustment for 2 items, the revaluation gain. And I think you can be able to recall the revaluation gain was 200 million. And then in sentence number 2 of note number 1, we are told this plant had an estimated remaining economic useful life for 5 years at the acquisition. And then we are told no fair value adjustment were necessary in respect of the acquisition of investment in 𝗘𝗃. So basically, what we need to do in respect to the revaluation of asset by Shower is to compute something called the depreciation other charge. How do we compute this? The first thing you need to record is the formula. We said we take the revaluation gain, divided that with the remaining useful life, and then you multiply that with the proportion of time. Proportion of time. The proportion of time here we said is the time difference between the date of acquisition and the date of consolidation. The date of acquisition and the date of consolidation. And actually, we know between those 2 dates, we have 6 months. In other terms, we are interested with the depreciation other charge for 6 months. So we take the revaluation gain as per note number 1, which we know is 200 million. We divide that with the remaining useful life, which is still in note number 1. The remaining useful life, which are basically 5 years, that will give us depreciation other charge per annum. But we are interested in the depreciation other charge from the date of acquisition to the date of consolidation. And between these 2 dates, we have 6 months. So we are interested in the depreciation other charge for 6 months. For 6 months. For 6 what? For 6 months. And this one will give us what? Are you getting 20 million here? 20 million. Depreciation, other charge, are you getting 20 million? Yes, 20 million. So that depreciation other charge, number one, we say that this one should be added to the group cost of sales. And number two, if we are preparing consolidated statement of financial position, we less it from the group PP. So in our case, we are not preparing consolidated statement of profit or loss, so we just add it here. But we said there are some questions you can be told that this depreciation is classified as part of the administrative expenses. If you're given that information, that means that that depreciation other charge, you will not add it to the cost of sales, but you add it to the administrative expenses. But if the question is hidden, any depreciation other charge, we said add it to the cost of sales. Yes, and I think in our case, basically we are done. Let's get the final values here. Let's get the final value. Let's get the final value. The final value here. The final value, we have 65 plus 23 minus 400 plus 40. Plus 40. Yes, that will give us 84, 40. Yes. So I think we can proceed and we get now the gross profit. The gross what? The gross profit. The gross profit will be how much? The gross profit will be 81 what? 81 60. 81 60. Is that what you're getting? The gross profit. The gross profit. The gross profit. Yes. Now, before we proceed to less the other expenses, here we can consider the group share. The group share over joint venture profit after tax. Remember, this is what we only consider here as far as this company is concerned, the associate. Sorry, the joint venture, not the associate. So that is what we consider here as far as the joint venture is concerned. So what we do, we go to the income statement of the joint venture. So can we go to the income statement of the joint venture, the 𝗕𝗏 Limited, and you tell me how much is its profit after tax, or the profit for the year for 𝗕𝗏 Limited? Can you see that value? The profit for the year, or the profit after tax for 𝗕𝗏, how much is it? Profit after tax of 𝗕𝗏 Limited, that one is 1,400. I hope you can see that. But now what we know is that that is the profit for the whole year. Is the parent company entitled to share the profit for the whole year? No, because it acquired this subsidiary equally 6 months to the end of the year. So the parent company is only entitled to share profit of 6 months. So because this is the profit for the whole year, first of all, we get profit for 6 months. And then we get now the group share of that. The group share should be 50%. The group share should be 50% of the profit for 6 months. Sasa, yes, we have gotten the profit for 6 months because the joint venture was acquired 6 months to the end of the year. And then we have gotten the group share. The group share. That will be what? Is it 350? Yes, 350. So I think we are basically done with that. Let's move now and we less the expenses. We proceed and we less the expenses. We less the expenses. We less the expenses. So for the expenses, we start with the first one, which is basically distribution. And recall, we say that anytime you come across a question for group accounts and you have the distribution, we say this item do not have any adjustment. No single question for group account whereby distribution cost is adjusted. So therefore, there's always a free mark. So you take that of the parent, which is basically 19, and then you take that of the shower. But for shower, recall, all items of shower, we are taking them for 6 months. Your portion items of incomes and expenses of shower for on time basis 6. You multiply everything with 6 over 12, which you said is equivalent to half. What is half of 1020? Half of 1020, is it 510? 510, yes. So we get the total amount here, which will be 2410. And because that is an expense, make sure you record it as a negative. So then from there we have the administrative expenses. Admin expenses, we do the same. We take that of the parent, 24, half that of shower, which is 840. And then we said ordinarily what we add to these administrative expenses is any impairment loss on goodwill. Recall, the goodwill on acquisition of shower was not impaired. So therefore, there was no any impairment loss. But any impairment loss for the current year, we should add it here. So in our case, we don't have that. We get the total, which will be 3240. 3240. I hope that is what you're getting. 3240, 3240. Confirm. Confirm, confirm, confirm. Is that what you're getting? Yes. So then from there, we proceed and basically we get the profit from what? Operations. The profit from operations, we take this plus that minus the two expenses. Minus the two expenses. Give me that value there. Give me that value. Give me that value. I'm given a figure of 2860. 2860. Okay. Yes. Then to this, we proceed and basically we less the finance cost. Finance cost. Now for the finance cost, we take that of the parent. That of the parent, which is 200. 200 plus we add half that of shower, which is basically 60. Now in this case, there is something here you must always remember to include in case you come across a question having deferred consideration. Remember, we say that the deferred consideration, which we have discounted with present value, that deferred consideration is an amount to be paid in the future. So that is a liability to the parent, and it has to be amortized. In the process of amortizing, there is always an expense. Anytime you are amortizing a liability, be it a loan, be it, for example, a lease liability, anytime you are amortizing a liability, there is something called what? There is something called interest. So therefore, what we need to do is to compute the interest on deferred consideration, and we include it here. Interest on deferred what? Consideration. Now recall, we computed the present value. Can you give me that present value of deferred consideration? It was how much? Was it 4,000? 5,600, which we discounted with present value, the deferred consideration? Yes. So that one was 5,000. So remember, this is the deferred consideration at the start of the year. This is the deferred consideration at the start of the year, which is 1st of April 2023. We know that this particular amount will be paid on 1st of April 2024. But when are we preparing our income statement? We are preparing our income statement on 31st. We are preparing our income statement on which date? No, sorry. This is at the date of acquisition. Is that the case? Because we computed the present value of this on this date here. That is the 1st of October 2023, which is basically the date of acquisition. Yes, the date of acquisition is that date there. So that is the present value of the deferred consideration on that date. Now, in our case, we know that this particular amount will be paid after 1 year. It will be paid after 1 year. That is the 1st of October 2024. That is basically the information we have in paragraph 1. But in our case, when are we preparing the consolidated income statement? We are preparing that on 31st of March 2024. So in our case, what we need to do, therefore, is to compute the interest from this date up to the date of consolidation. Up to the date of consolidation. And remember here, how many months do we have? We have said we have 6 months. October, November, December, January, February, March. We have 6 months. So meaning that the interest we are going to recognize here will be from this date up to that date. The interest for the current year. Yes. So how do we compute that interest? The interest should be computed using the parent company cost of capital. Remember, the cost of capital is per paragraph 1 is 12%. 12% of this one, that one will be the interest for the whole year, but you're interested with the interest for 6 months. The interest from that date to that date. So 12%, 5,000 times 6 over 12. So that is basically the interest on deferred consideration. That one should be around 300. 300. Yes. So we get the total finance cost as what? Is 560. Is that correct value? Yes, because that one will be 300 plus 260. Yes. So then from there, what else do we have? We need to get the profit before tax. The profit before taxes. Let's get the profit before tax. The profit before what? Before tax. So the profit before tax here will be how much? Will be 2,300. will be 2,300. And then to this, we less tax. Remember, we said tax is another free mark. If you happen to come across a question for group account, income tax distribution, including this one, make sure you get those particular marks there. Sasa is because we said generally these one do not have any adjustment. So we take the income tax of the parent. The income tax of the parent is how much? The income tax of the parent is 450, 450, and basically we add half that of shower. Half that of shower, which is basically 380, and that is half of that is 190. No adjustments there. That one is always a free mark, just like a distribution, just like what? Distribution cost. So this will give us a total of 640. 640. I hope that is what you're getting. 640. 640. Yes. So then from there we get the profit for the year. The profit for the year. So how much will be the profit for the year here? How much will be the profit for the year? The profit for the year, in this case, I'm told would be 16 what? 1660. Now, having this, then we need to proceed and we record other comprehensive incomes. Other comprehensive what? Incomes. Other comprehensive incomes. Other comprehensive incomes. Now, the other comprehensive incomes, basically we have those of the, actually we have revaluation on property for the parent, and basically for subsidiary is nil, and then we have that of a joint venture. Now, what do we include here? Number one, for the parent company, the revaluation, the gain on revaluation of property for the parent, we include the full amount. So we have revaluation on property. Property. So basically, in this case, I'm saying for the parent company, which is held, we take the full amount. We take the full what? The full amount, just like what you have done to the other items of income and expenses. But now the one for subsidiary, that is shower, equally we should apportion that on time basis. So if, for example, we had a revaluation gain for shower, we apportion that on time what basis? We apportion that on time what? On time basis. In our case, that one is basically 0. That one should be for the subsidiary. Now, for the other company, that is the whole, do we include it here? Yes, we should include the group share of that 200, just like what we have done to the profit for the year. So therefore, for shower, maybe I think we can. This one is the parent. This one is for subsidiary, and then we can compute for joint venture here separately, which is 200. That one is the revaluation gain for the whole year. And that's why if you take on the information you have in note number 5, you're told assume incomes, expenses, gains. Gains are these revaluation gain, and also losses were accrued evenly. So therefore, the parent company will not be entitled to share the revaluation gain for the whole year. The parent company will be entitled to share this revaluation gain for the joint venture only for 6 months. I've said just like how we have computed what? How we have computed this. So we compute the revaluation gain for 6 months. Like that. And then we compute the group share of that. The group share of that, just like what you have done to the profit, will be 50%. Will be 50%. That is basically what we include here. The revaluation gain of the parent company for the whole year, revaluation gain of the subsidiary, you apportion that on time basis, and then the revaluation gain for the joint venture, you take the group share. The group what? Share. So because the joint venture was acquired 6 months to the end of the computed the revaluation gain for 6 months, then get the group share of that, which is 50%. So this one should be 100, 100, and then 50. So that one would be 50 plus this one, which would be 220. 220. And I think in our case we are done. So this will be the total comprehensive what? The total comprehensive incomes, which is basically 18 what? 1880. 1880. So that is it. That basically what is required in that question there. And you can see the marks allocated here were 14. So remember what we said is marked in this particular question are not even the workings. What is marked is the final answer here. This is what is marked. That is the answer, which is this is what is basically marked. This one. So yes, that is what is marked. The final figures there. And not even this any figure which you get by adding or deducting. For example, gross profit has no mark there. No mark for this one. No marks for this. No marks for this. No marks for this. So what unmarked are these entries? These entries there. Those what? Entries. So in most of the cases, you'll see like this question. This is how it was marked. N7 at 2. Any 782. How many entries do we have here? We have 1, 2, 3, 4, 5, 6, 7, 8. 8. So, but in this case, recall what you have said. At least this question you should be able to get. For example, income tax, this one you should get it. Distribution cost, you should get that, including revenue. So basically here, you should be guaranteed of getting 3 correct entries. Though you can see other items are also free, because you can see also like admin, no adjustment for that. Although some items here like cost of sales and maybe the finance cost, there are some adjustments there. Some adjustments. Yeah, so that is it. That what is required in relation to that.